Hi, my name is Aman and I'm a chartered professional accountant. In this video, I will explain the tax implications of converting your home into an income generating property. Most Canadians recognize the principal residence exemption as one of the most critical tax breaks available to them. However, in many situations, such as when a family owns multiple residences, the change in the use of a home from personal to income producing, or vice versa, or a marriage breakdown, the optimal use of the principal residence exemption is somewhat more complicated. In this video, I will use Mark's story to explain. With help from his bank, Mark purchased his principal residence in 2016 for $400,000. He owned and lived in this home from 2016 to 2017, and in 2018 the home was valued at $450,000. However, he found that the old house wasn't really satisfying his needs anymore, and he was looking to move to a bigger and better home. The old home had increased substantially in value. He anticipates that the real estate market will continue to appreciate and expected that his home will be worth $550,000 in 5 years. So he decided to keep the house and rent it out. Mark had heard from his friend that if he changes the use of his home, that is, if he converts his home to a rental property, he has to pay a heavy amount in taxes. As a result, he got very worried and felt it was unfair that he has to pay tax without even selling the house. So Mark decided to go to his chartered professional accountant. The accountant studied his case, and since Mark converted his principal residence into an income property, the accountant told Mark that he is subject to something called change in use rules, and he is deemed to have disposed of the home at fair market value, that is $450,000. Well, the accountant presented two scenarios in front of Mark. The first option was that Mark uses the principal residence exemption to shelter the tax on the capital gain of $50,000. That is $450,000 minus $400,000. If he sold the property in 5 years, his anticipated $550,000 price, then he had to pay 50% of his increase in the value of $100,000. That is $550 minus $450,000. The second option available to Mark was to file an election, so that the change in use is deemed not to have occurred by filing the election. Instead, the disposition can be deferred until the property is sold. Assuming he sold the property in 5 years for $550,000, the exemption can be used to shelter the entire $150,000 capital gain. Because of the 4 additional years, he could designate the property by filing the election. Mark was delighted that he consulted the accountant to save tax and followed his advice to file the election by attaching a signed letter to his tax return for the year in which the change in use occurred. For the election to remain in force, on his accountant's advice, Mark did not claim depreciation, which is also called CCA, on the property and reported all net rental income on his tax return. The best part about this election was that Mark could continue to designate the property as his principal residence for an additional 4 tax years while the property was being used to earn rental income. Well, Mark had now gained clarity on how the real estate transactions need to be structured and reported in order to save the tax dollars. If you want to be notified about our new tax stories, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Until then, bye.